Question number one, do you think this recession, question mark, is worse than 07, 09? I didn't need to get a second job then. Will I now? So it's impossible to know for sure. What I will say is that the 2007 to 2009 recession, or which is sometimes referred to as the Great Recession, there was a huge asset bubble in the housing market in particular. And because of that housing market bubble, the impact was very widespread. The fallout on Wall Street that required like a big bailout of banks, the reason they did that was so that you didn't have a total collapse of Main Street as well. And so when you hear people talk about Wall Street and Main Street, so Wall Street is sort of like all the big investment banks. Main Street oftentimes is a term they use to kind of refer to everyday people on the street, right? They didn't want there to be a mass like homeless crisis, a mass foreclosure process. And so they tried to create ways to allow people to stay in their homes and to not have all those losses, to limit the fallout and contagion and spread of kind of the implications in the 2007 to 2009 market. So for leading up to that, a lot of people had been kind of using their homes as an ATM. When you have 20, 30, 40% home price appreciation in a very short period of time, it gives people significant equity in their homes. And so people would refinance, take that equity out, or sell and have a bunch of cash that they could use then to either reinvest in housing or spend. And so we don't have necessarily an asset bubble per se in the housing market right now. Some people think that the price appreciation over the last couple of years, that we might see kind of that fall out. We don't have a whole bunch of bad mortgages like we did back then. We don't have a whole bunch of mortgages that are going to, are interest only, that are going to reset at higher rates and are going to force a lot of people out of their homes. In fact, most of the mortgages issued over the last couple of years were to higher credit-worthy borrowers than ever before. They've also all locked in extremely low interest rates. So if anything, if they tried to buy a new house right now, it would actually cost them significantly more for less house because their interest rates are so low right now. So that puts an element of kind of security in the housing market that didn't exist in kind of that 07, 09 time horizon. Where we are seeing kind of the bubble or the deflation come out, or the air coming out of the bubble, is in more speculative areas. So like what we're seeing happen in the crypto market with the collapse of FTX and things like that. We're seeing some of it happen like in the tech sector. So when interest rates are zero, it eliminates an element of risk and kind of sanity when it comes to investment, and people are willing to take more risk than they might otherwise. So around the edges, we're seeing it happen in things like venture capital investing. We're not seeing kind of, venture capital funds giving money to people with like no proof of concept and no revenue and things like that. It's why you're seeing the big layoffs in the tech sector, because they doubled, tripled, quadrupled the size of their workforce when interest rates were zero. And now that interest rates are something, they realize that like they're going to have to adjust their return on capital expectations. They're going to have to cut costs, kind of these, spend whatever you want, hire whatever you want, have these extravagant expense accounts is going away in the current environment. So that's some of where you're seeing the air come out of the bubble in some of those areas right now. Could that have spillover effects to other areas? Yes, potentially. The other place you're seeing kind of air come out is in consumer spending in general. I shared like a week or so ago kind of where consumer credit levels are at. Like that is not sustainable. We had significant consumer spending over, call it the last 12 to 18 months from things like the stimulus checks. That's not happening again, right? So the comparisons are very difficult. Plus you had those stimulus checks allowed consumers to pull a lot of demand forward. So what does that mean? It might have meant that like you were planning to buy a car in the next year or two, but instead you like a whole bunch of people bought them last year. Like that pulled demand forward and basically kind of stole it or robbed it from a more rational or more ratable experience. And so now there's kind of a hole that we're going to go through and experience. Those are the things that are contributing to kind of the likelihood of a recession that people are talking about and have been talking about for, call it, the last 6 to 12 months. So the question of, will it be as severe? Now I think the question that most people have is like, How severe will it be? How prolonged will it be? Like, how long will it last? How high could unemployment go? How long could it take us to see a recovery? And I think the answer to that is still kind of uncertain, and that's where the current uncertainty lies. I think it's a function of how long is it going to take inflation to come down? So how high is the Fed going to have to hike interest rates? There are some kind of, in the last couple of weeks, we've seen the market rally a little bit. Part of that is because people think that the slowing inflationary print that we saw for October that came out, I don't think last week, but the week before, people took that as an indication of like, oh, inflation is slowing down. Yes, it is, but it is still multiples above like the target that the Fed has. So nobody, I don't think, would expect them to drop interest rates in December, but maybe they don't hike them as much as they've been hiking them. And so that's where some of like the market rally has been coming from. But the Fed very clearly in November, and also their various members of the Board of Governors who've given speeches in public since then, have said that like the optimism is definitely like, if not warranted, but definitely maybe a little too much given what they're still seeing and what their plans still are to come. So just something to keep in mind. So that's one thing that's going to determine kind of the length and the duration of a downturn. The other thing is just uncertain kind of geopolitical forces that are largely beyond any of our individual control, right? So how long is this conflict in Europe going to drag out? Because that has implications on things like food supply and energy prices and supply chain. That all factors into that as well, because like it or not, like we very much, and I think the pandemic highlighted this to an extreme for everybody, like we very much live in a global economy. So we can't isolate ourselves from the impacts of those things. And so that is kind of another big uncertain area that is weighing on the current economic environment. It is a source of inflationary pressure. And so that's going to have an impact in terms of like, how long is there going to be heightened interest rates? How long is it going to take to rein inflation in? How long could that mean that unemployment is potentially elevated? And again, we're really just at the beginning of that. Like we're really now just starting to see, okay, there's layoff announcements. We're starting to see those record levels of job openings are just starting to come down. And we're not even really starting to see unemployment increase yet. But I think anybody kind of who's watching the data expects that to be coming. So I would say we're kind of at the beginning and we're not, in a recovery yet. And the question of like, how bad could it be is one that is unknown and uncertain at this point, which is why from a responsible financial perspective, I've been telling you guys like, make sure you have this stable emergency fund. Make sure that you have a bare bones budget prepared. Make sure you have sense of like your personal job security. I would caution and think twice about switching jobs in the current environment, just because of all of those kind of looming uncertainties right now. All of that being said, if you look, the next 12 to 18 months, I would say we don't know exactly what that's going to look like, how bad it could be, how high unemployment could get, all of that. However, from a financial perspective, over the long run, all of my, usual expectations remain the same. So I still expect over the long run in the stock market to generate a 9% return on average. So when the market is way down, it is a good time to invest. So you should continue investing if you can. However, I would also prioritize having access to cash, having a solid emergency fund in order to ride out the next kind of uncertain 12 to 18 months. So I hope that helps. I know, everybody kind of wants a black and white answer to things. And the reality is that finance just doesn't work that way. So the way it works is when there are periods of economic uncertainty, you want to be prepared to still be standing and strong on the other side. And the way you do that is by having things like a solid emergency fund and cash to access through the period of economic uncertainty. So I hope that helps and kind of gives the rationale behind kind of some of the things we've been talking about here lately.